National income accounting involves a set of key terms that help us understand the economic performance of a country. By measuring economic output and income, these concepts provide a clear picture of how resources are produced and distributed within an economy. Terms like gross domestic product, net national product, and personal income are essential for tracking growth, comparing economies, and guiding policy decisions. Accurate measurement of national income allows governments and analysts to assess living standards, identify trends, and make informed economic choices. Gross domestic product at market price, or GDPmp, is a key economic indicator that measures the total value of all goods and services produced within a country's borders during a specific period, typically 1 year. It is calculated by summing the market prices of final goods and services, reflecting the actual prices paid by consumers and businesses. GDPmp includes the impact of indirect taxes and subsidies, providing a comprehensive view of the economy's output. This metric represents the overall economic activity and production within a nation, serving as a benchmark for assessing growth and development. By analyzing GDPmp, economists and policymakers can gauge the health and performance of a country's economy. Gross national product at market price, or GNPmp, is a key economic indicator that measures the total value of goods and services produced by a country's residents, regardless of where they are located. Unlike gross domestic product at market price, which focuses solely on production within a country's borders, GNPmp adds net factor income from abroad. This means it includes earnings from citizens and businesses working or investing overseas, minus payments made to foreign entities operating domestically. The distinction is important because GNPmp provides a broader picture of a nation's economic activity and its global financial connections. Understanding this difference helps in assessing the true income generated by a country's residents and their impact on the international economy. Net domestic product at market price, or NDPmp, is a key economic indicator that accounts for the impact of depreciation on a nation's output. Depreciation refers to the gradual wear and tear or obsolescence of capital goods, such as machinery and buildings, over time. By subtracting depreciation from the gross domestic product at market price, NDPmp reveals the actual value of goods and services available for consumption and investment. This measure provides a more accurate picture of the resources that remain for use within the economy after maintaining existing capital. Understanding NDPmp helps policymakers and analysts assess the true productive capacity of a country. Net national product at market price, or NNPmp, is a key indicator that measures a country's economic output after accounting for depreciation. By subtracting the value of worn-out or obsolete capital goods from the total national product, NNPmp provides a more accurate picture of sustainable economic growth. This adjustment ensures that the nation's productive capacity is not overstated, reflecting only the net addition to wealth. Over time, tracking NNPmp helps policymakers assess whether the economy is truly expanding or merely replacing depreciated assets. As a result, NNPmp serves as a valuable tool for understanding the long-term health and progress of a nation's economy. Gross domestic product at factor cost, or GDPfc, measures the total value of goods and services produced within a country, calculated based on the costs of production factors like labor and capital. In contrast, gross national product at factor cost, or GNPfc, includes not only domestic production, but also income earned by residents from abroad, minus income sent to other countries. The distinction between market price and factor cost lies in the inclusion of net indirect taxes, such as sales tax and subsidies, which are added to factor cost to arrive at market price. Net indirect taxes are subtracted from GDP at market price to obtain GDP at factor cost. This adjustment ensures that the measurement reflects the true earnings of production factors, excluding the impact of government-imposed taxes and subsidies. Net domestic product at factor cost, or NDPfc, represents the total value of goods and services produced within a country, after accounting for depreciation and measured at the cost of production factors. Its main components include compensation of employees, which covers wages, salaries, and Social Security contributions. The operating surplus refers to the profits earned by businesses after paying for labor and other inputs. Mixed income captures the earnings of self-employed individuals, reflecting both their labor and capital contributions. Together, these elements provide a comprehensive picture of the income generated from domestic production activities. Net national product at factor cost, or NNPfc, is calculated by subtracting depreciation from the gross national product and then adjusting for indirect taxes and subsidies. This measure reflects the total income earned by a country's residents from production activities after accounting for the wear and tear of capital assets. NNPfc is considered a crucial indicator because it provides a more accurate representation of the nation's actual income, excluding distortions from government interventions. Its standardized calculation makes it particularly useful for comparing income levels across different countries. By focusing on factor cost, NNPfc helps economists assess the true earning capacity of a nation's economy. Transfer payments are sums of money given by the government or other institutions to individuals or entities, without any goods or services being exchanged in return. These payments are categorized into current transfers, such as Social Security benefits and unemployment allowances, and capital transfers, which include items like disaster relief funds or debt forgiveness. Current transfers typically support day-to-day consumption, while capital transfers are intended for long-term investment or recovery. Importantly, transfer payments are not included in the calculation of a country's gross domestic product, but they do play a significant role in determining personal and national income by redistributing resources across the economy.